Hello everyone and welcome to Earth Archives. Have you ever heard of the terms QE? It sounds so complicated. I've heard it has something to do with finance.
Haha. QE stands for quantitative easing. Sounds like magic, right? But it's actually just a way for central banks to inject money into the economy during crisis.
Inject money? Will the money flow into my house?
Haha, don't worry. It won't literally splash into your kitchen. This money is actually cash flowing through financial markets, like pouring water into a river to get the whole economic system moving.
So how do they inject the money?
Step 1. The central bank creates money to buy assets. And no, it's not printing bills like you might think. They just type numbers on a computer. It's like clicking add coins in a mobile game. This new money enters the market.
Really? No paper money involved?
Really? For example, if the Federal Reserve decides to buy $1 trillion worth of government bonds, they don't carry cash to the transaction. They simply deposit new money into bank accounts. The banks selling the bonds suddenly have extra funds. These are called excess reserves.
So won't the banks lend it to us immediately?
In theory, yes, if banks have money, they can lend it. But in reality, banks still consider the risks. The central bank's idea is that having this money sitting in banks boosts their confidence to lend.
Alright, so how does this affect interest rates?
That's one of QE's main goals. When the central bank buys a lot of bonds, bond prices go up and yields, that is, interest rates, go down, especially long-term rates. Mortgage rates and corporate borrowing costs follow suit.
Oh, so borrowing becomes cheaper, and people feel more confident spending and investing?
Exactly. The central bank isn't handing money directly to you. It's lowering the cost of borrowing to indirectly boost consumption and investment.
What about asset prices?
That's step 4. Banks might not lend all the money, but the funds have to go somewhere. The money ends up in stocks, real estate, even Bitcoin. Asset prices rise, people feel wealthier, and their desire to spend grows.
So that's what they call the wealth effect.
Right. On the surface, the economy seems to recover. Unemployment drops, GDP rises, the stock market heats up, and the media reports economic improvement everywhere.
QE sounds almost magical.
Don't get carried away. That's just the surface. QE is like a doctor giving a patient a strong shot of adrenaline. The patient looks stronger, but the root problem isn't solved, and there can be serious side effects.
Side effects? Can you give some examples?
Sure, let's break it down step by step. First, market interest rates get distorted. Interest rates are really the price of time. They reflect how willing people are to defer spending now for the future. When the central bank suppresses rates, it twists this signal. Businesses and individuals think money is cheap and investment opportunities are abundant, leading to a false sense of prosperity.
Does it affect capital allocation too?
Yes. Capital allocation is about how society distributes resources, machines, raw materials, labor, technology, across different productive activities. Low interest rates push funds toward projects that look high return on the surface, like real estate speculation or financial gambling, while small businesses and real productive investments get squeezed out.
What about savers?
Absolutely. People who worked hard to save money see their interest earnings shrink, sometimes even turn negative, slowly eroding their purchasing power. Meanwhile, those with capital get richer as asset prices rise, accelerating wealth transfer and worsening social inequality.
Does this affect financial markets too?
QE makes the central bank the biggest buyer in the market. Interest rates and risk pricing are no longer set by the market. Investors end up just following central bank announcements. The market loses its ability to self-regulate.
What about inflation? Some people say QE causes inflation, right?
Not necessarily, at first. The CPI might not rise immediately because the money can be trapped in the banking system or financial markets. But once confidence shifts and money flows into the real economy, inflation can spike. The US after the pandemic is a good example. CPI shot above 9%, and living costs surged.
Wow, QE seems like an emergency fix, but it can actually create bigger risks.
Exactly. That's why the Austrian School of Economics emphasizes that money should be guided by the market, with interest rates set freely. This allows the market to naturally correct bad investments, which is healthier for the long-term economy.
All right, what I really want to know is, what does a real QE case look like? You mentioned Japan had a lost 30 years. What happened there?
Okay, let's start with Japan. In fact, Japan was the first country to implement QE in the early 1990s.
What was happening with Japan's economy at that time?
Japan had just gone through the bursting of its stock market and real estate bubbles. Banks were full of bad debts, and waves of company bankruptcies followed. The whole economy was like a deflated balloon, completely collapsed.
So what did the Bank of Japan do?
They started by cutting interest rates to nearly zero, then began large-scale purchases of government bonds, injecting massive amounts of money into the market. This was the early form of QE.
And the result? Did the economy recover?
The result was quite sad. Japan's economy remained in long-term stagnation, inflation hovered near zero, and deflation, falling prices, was common. Banks had money but were reluctant to lend, companies didn't want to invest, and the economy became like a stagnant pond.
Wow, so Japanese people didn't spend?
Exactly. Because prices weren't rising, people lacked incentive to spend. The bubble burst also left psychological scars. People saved more than they spent, corporate efficiency was low, the population was aging, and society fell into long-term stagnation.
So QE was just a temporary painkiller, not a real solution?
Absolutely. Even worse, government debt ballooned, and the central bank became the biggest buyer, basically moving money from one hand to the other. On the surface, it looked like there was liquidity, but there was no real economic vitality.
Sounds really risky.
It is. Japan's experience shows that QE can't fix the root problem. It only temporarily makes the economy look less bad.
What about the US? I heard there was QE during the 2008 financial crisis.
Yes. The U.S. started large-scale QE after the 2008 financial crisis. Lehman Brothers collapsed, global stock markets plummeted, and the American banking system was on the brink of collapse. The Federal Reserve cut interest rates near zero and started creating money to buy government bonds and mortgage-backed securities.
Did that money reach ordinary people?
Not really. Most of the money got trapped in the financial system, pushing up stock and housing prices. Wall Street and big institutions got richer faster, while the middle class and the poor just watched living costs rise.
So on the surface, stocks went up and housing recovered, but real life didn't improve?
Exactly. After 2008, U.S. stock markets hit record highs, but many ordinary families still felt financial stress. That's partly why the Occupy Wall Street movement happened. People were frustrated that the financial system only benefited the rich.
So is the US safe after QE?
Not really. QE only solved the immediate crisis, but planted the seeds for the next bubble. With so much money flowing into stocks and real estate, the financial market became dependent on the central bank. Once policies tighten and the bubble bursts, a new crisis can erupt.
And during the COVID pandemic, the US did QE too, right?
Yes, that was QE4, called Infinite QE. The Fed bought almost everything: government bonds, corporate bonds, ETFs. The U.S. Treasury even directly gave money to citizens, temporarily stabilizing the market and preventing systemic collapse.
It stabilizes the short term, but what about the long term?
That's where the problems pile up. After 2021, the U.S. faced its worst inflation in decades. CPI shot above 9%, and gas, food, and rent all surged. The Fed had to raise interest rates aggressively, hitting the brakes, which triggered a wave of bank failures, including Silicon Valley Bank and Signature Bank.
So QE is like playing with fire, solving an emergency while creating bigger risks.
Exactly. From Japan to the U.S., QE works in the short term but never really cures the economy. Instead, it widens wealth gaps and increases financial market risks.
Then what should ordinary people do?
The Austrian School of Economics gives us a clue. They argue that a truly healthy economy can't rely on central banks printing money. It must return to free market logic, money guided by the market, interest rates set freely, letting recessions clear bad investments and reallocate resources.
Money guided by the market? That sounds abstract.
Let me give you an example. Imagine a village where people trade using water from a well. The water was originally clean and reliable, but suddenly the manager secretly adds water, mixing it in. It looks like there's more water, but trust falls. Money works the same way. Print too much, market trust declines, and purchasing power gradually erodes.
So what should we do?
The Austrian school suggests several directions. First, use hard currency to limit monetary expansion, like the gold standard. Second, let interest rates be set by the market. Third, don't use monetary tools to rescue recessions. Let the market naturally clear bad investments. Fourth, allow currency competition, so people can freely choose which money to trust.
So it's not about saving the economy, but letting the market regain health on its own?
Exactly. The market isn't a patient. It's a complex, self-regulating machine. Too much central bank intervention actually disrupts its order.
All right, I really want to understand. What does money guided by the market mean? It sounds a bit abstract.
No problem. Let's break it down. Imagine money like water in a village well. The water was originally clean and reliable, and everyone trusted it for trading goods and services. But if the manager secretly adds water or something else, there's more water, but trust declines, and transactions start to fail.
So money is basically the cash we use to buy things, right?
Exactly. The value of money comes from trust. Scarcity and reliability are very important. If the central bank prints unlimited money, the supply increases, but purchasing power is diluted, and inflation gradually erodes our lives.
So how does the Austrian school address this?
They have a few core principles. First, use hard currency to limit monetary expansion, such as returning to the gold standard.
Gold standard? You mean every bill is backed by gold?
Exactly. This prevents governments or central banks from printing money arbitrarily. The scarcity of money is preserved, and people's trust in it remains intact.
That sounds pretty strict. Wouldn't it limit economic growth?
Not really. Because you can't just print money. Businesses have to earn through efficiency and real value, not from the fake profits inflation creates. This actually encourages sound investment and long-term growth.
What's the second principle?
Interest rates should be set by the market, not controlled by the central bank. Interest rates act like a conductor's baton, signaling to businesses and consumers where to allocate resources. If the central bank suppresses rates, people think money is cheap, leading to overheated investment, real estate speculation, tech bubbles, and rampant gambling.
So low interest rates aren't necessarily good?
Exactly. Low rates may temporarily boost the economy, but they misallocate resources and are dangerous in the long run.
And the third principle?
Don't use monetary tools to rescue a recession. Let the market naturally clear bad investments. Imagine a forest. Too many dead branches need to burn naturally before new life can grow. Recessions are the market clearing out bad investments. Intervening artificially just prolongs mistakes and makes future crises worse.
That's a vivid analogy.
Yes, many people fear recessions and think immediate intervention will save the economy. But the Austrian school teaches that recessions are actually part of self-repair.
And the fourth principle?
Allow currency competition. Let people freely choose which money to trust, not just one legal tender. It could be gold, silver, Bitcoin, stablecoins, or even private currencies, as long as both parties agree.
So the market will automatically weed out unreliable currencies?
Exactly. The market selects the most stable and trustworthy currencies. Only those widely trusted get used. This freedom limits governments from overissuing money and also encourages innovation.
So to summarize, the Austrian school advocates hard currency, market-set interest rates, allowing recessions and currency competition, all to maintain a healthy economy?
Exactly. In simple terms, they see the market not as a patient that needs rescuing, but as a complex system that should regain healthy order on its own.
Sounds idealistic, but how can ordinary people apply this in daily life?
There are a few practical approaches. First, diversify your assets. Don't keep everything in cash or stocks that are vulnerable to QE and inflation. Include hard assets like gold, silver, or stablecoins.
That protects purchasing power?
Yes. When money is diluted, hard assets don't easily lose value. Second, invest rationally. Don't blindly borrow at low interest rates to chase trends, avoiding misallocation of resources. Third, maintain savings habits, avoid overspending, and cultivate a sense of security for the future.
Wow, it sounds like the Austrian school isn't just theory, it can actually apply to our daily lives.
Exactly. The core idea is to protect personal wealth and avoid being hurt by the side effects of financial policies.
So if QE has already happened, what can ordinary people do?
The strategy is to protect your assets, spend and invest rationally, diversify your money, and not get swept up by short-term market trends. That's how you ride out the volatility caused by central bank policies.
So QE might look like a lifesaver, but underneath, it hides many risks. We need to open our eyes and see it clearly.
Exactly. QE saves the numbers on the surface, but amplifies wealth gaps. The long-term effects are what everyone should really care about.
All right, I've learned a lot today. Money, interest rates, recessions, and asset allocation are all closely connected to our lives.
Right. Understanding these concepts is how you protect yourself in an unpredictable financial world. Don't forget to subscribe, like, share with friends, and tell us your thoughts on today's topic in the comments.